Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get a look at where the action is in the equity markets with
Bailey Lipschultz.
Bailey Lipschultz. Thank you. Sitting right next to me, Bailey Lipschultz. You can talk all you want about stocks. I only have one question for you. Can you explain to me what our good friend Bill Ackman is doing here?
Nothing now.
Nothing
well,
now.
as of now.
Can you walk us through this story here?
So earlier in the month, well, I guess now we're in August. So in July, he filed to launch and price a closed-end fund that would trade in the U.S. It would be similar, in his words, essentially mirror their European offering, which currently trades under the ticker PSH space NA. Trades at a 20% discount to what the assets that it owns. It's invested in Alphabet, Chipotle, Howard Hughes, Universal Music, a handful of stocks. Beating the drum, he kind of said, we see this as a potential $25 billion offering going to court retail. We're going to court institutions. Basically, I have a lot of very wealthy friends. They're going to give us money. It's going to be awesome. It's only going to be a 2% fee. We won't charge that for a year. Then a couple days later, he wrote a letter to investors in the hedge fund saying, hey, demand's not as strong as we would have expected initially. We're thinking that maybe we'll raise between $2.5 billion and $4 billion. So a sharp drop off from the $25 billion number. He actually name dropped Seth Klarman's bow post. He name dropped Putnam, among others, kind of alluding to people who were already in for the book, saying, get your orders in soon. It's going to help us build this out. Didn't realize that had to be filed publicly. So the next day we see that in a public filing, or at least that's what we're told through the filings. Seth Klarman and Bloomberg has reported, isn't super happy about that. They withdraw their order, they opt out. We see just a few days later, the fund coming back saying, we thought $2.5 to $4 billion. Now we're actually going to go after $2 billion, but don't worry, it's going to price next Monday. So we're still kind of full speed ahead, $2 billion, feeling great. Pershing Square's in for $500 million. Then yesterday we get the filing that to kind of oversimplify, because they couldn't answer the question that investors wanted to know, why would I buy this at IPO when I can buy it at a discount? We're actually going to pull the offering, rework it potentially, and try to come back with a different model. So going from $25 billion to potentially $4 billion to $2 billion to now nothing as of now. Though again, he did say they plan on coming back in some potentially different formation.
I don't know what to even ask about that. That was a great explanation, by the way, but it's such a nightmare.
But my angle is, there's an angle here. He's a really smart guy. How do you misjudge the market? How do you misjudge demand? How do you make that mistake of putting out a letter? These are things Bill Ackman doesn't do.
Well, so to start at a high level, the largest closed-end fund in U.S. history was just over $5 billion.
Okay.
So he was coming in with the ambition to 4X that, because he has 1 million and change followers on X, and he has a strong track record. If you even look at and invested in the European offering, you've done pretty well over the last few years. But to your point, there's so many snags that came out of this. And when I talk to people who operate in the closed-end fund space, they initially were kind of saying, this has to go through a seasoning period. The SEC is going to hold it up, which Pershing Square came out and said was actually playing a factor in the delayed pricing, to the extent that I talked to a couple advisors who said, maybe September, just because you need this to cool off. The way this is structuring, you can't just kind of ignore these warning signs and keep your pedal to the metal. And it does seem like a number of miscalculations have kind of ended up throwing it into a tailspin.
Wow. It's literally, like yesterday, he was on at the exact same time. We were talking about the different evolution of the story. All right, Bailey, you'll be coming back at the top of the 11 as well. Bailey Lipschultz joining us, Bloomberg senior equities reporter joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, let's go to the individual movers here. One of them is Meta. That stock popping 10%. Did you listen to the earnings call on the beach? He did.
Part of it.
Oh,
but then a nice swell came in, so I had to drop and go.
I understand. I mean, that's priorities.
Yep.
Mandeep Singh was not at the beach on the earnings call, and I know this because he was on set with me when the numbers came out. Mandeep Singh, Bloomberg Intelligence senior tech industry analyst. you were pretty positive on Meta earnings, and the street really agrees with you. This is AI delivering on helping more targeted ads, meaning more revenue. Straight up.
Yeah, and I mean, look, with all the other AI spend that we are seeing from the cloud vendors, they're saying the revenue will come in 25, 26. Meta is actually delivering AI revenue right now. And that's the big surprise, that all the large language model investments they have done, they have infused their apps with AI, and it's actually yielding tangible returns. And there was a good macro read too. I mean, my sense was e-commerce spending is strong. Gaming spending is strong. That's why there are advertisers who are spending on Meta platforms. So overall, I think macro looks to be much better than what people talk about. And ad spending is strong, and that's why Meta did well.
Is this a read across for Amazon, for Google in terms of the ad spending angle?
Absolutely. I mean, Amazon is skewed towards e-commerce. In fact, anybody who is an e-commerce provider on Amazon's platform has to spend on ads for, slotting. And so I do think, and certain pockets when it comes to ads aren't doing well, which is why Google didn't have that sort of a lift, because they are sort of equal across different sectors, automotive, insurance. Those are the weak sectors. So they're probably not spending as much on ads. But e-commerce, retail, these are the pockets where the ad spending is strong. And I think Snap should do well tonight.
So the CapEx spend also, so they narrowed the range specifically to come in for 37 to 40 billion rather than 35 to 40 billion. They didn't raise it, which is not what some of the peers have done. Was that also a positive for the stock?
Absolutely. I mean, they've learned their lesson. Last time around, they raised the CapEx by 3 billion. The stock reacted negatively. This was more a wait and see approach. They did say 2025 CapEx will go up like every other hyperscaler. But for this quarter, they actually came out below consensus, $1 billion below consensus when it comes to CapEx for this quarter. And like you said, they reaffirmed the guide. And overall, I feel like everyone keeps talking about how they are GPU constrained and they need to spend more CapEx. Meta didn't say that they are GPU constrained in any way. At the same time, they expect AI infrastructure spend to go out, and they're able to monetize it. WhatsApp, to me, was the real bright spot. I mean, nobody has been able...
Are they monetizing that yet?
Actually, yes. So they did give a data point yesterday where family of apps, other revenue grew 73%. Most of it is WhatsApp. So WhatsApp actually is a $400 million run rate business now.
Really? Okay.
Yeah.
It's only taken 10 years.
And that's where I think they called out the US adoption. So WhatsApp now has 100 million active users in the US. And that's where they see AI infusing in WhatsApp being a revenue generator.
All right. Market likes it. Stock's up 9% today, up 47% year to date. All good in Meta land. Tonight after the close, Amazon and Apple. Let's start with Amazon. What are you going to be looking for there?
I mean, cloud, AWS growth, ads growth. I think that one thing that stands out between Google, Microsoft, and Meta versus Amazon and Apple is Amazon and Apple don't have their own large language model. One thing we realize with Meta is because they own their large language model, they've been able to deploy it so quickly. Well, Amazon is relying on Anthropic to give them the large language model. Apple announced Apple Intelligence, but they're delaying it. They don't have their own large language model. And what everyone is realizing is owning a large language model like Microsoft OpenAI, Google Gemini, that's a big advantage. And that advantage may continue, I think, given everyone is so bullish on generative AI.
So how is that going to wind up showing up in the numbers?
So, I mean, look at Meta's ad pricing. The reason why ad pricing grew so much is because they actually applied the large language model on their own products. Same thing with Microsoft. The reason why Microsoft's cloud revenue has accelerated is because the workloads are getting deployed, the co-pilots are getting deployed in their own products. So Amazon has to somehow, leverage the large language model, Anthropic or somebody else's. In fact, Meta said they are warming up to Amazon more and more to deploy their Llama large language model on AWS. That'll be an interesting partnership if that pans out, because Meta doesn't have a cloud-facing business, whereas Amazon AWS is the largest cloud provider. If they can leverage Llama model, which Meta owns, that could be a huge driver of revenue for both Amazon as well as paying a licensing fee to Meta. But obviously, nobody called that out, so that's a speculation at this point.
Fascinating. All right, really good stuff. Can't wait.
It's not just selling ads anymore. It's all this other stuff.
It's so much all other stuff. Well, it is about selling ads, but in a more efficient way. All right, I took my notes for those coming out after the closing bell. Mandeep Singh, Bloomberg Intelligence, Senior Technology Analyst. There we go. I got it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
That ISM number, that's ugly.
That got my attention there, yeah.
Also, the jobs number, the employment number in there, what, 43? Yep. That's definitely something. Interesting that we're seeing the buying really coming in, though, to the bond market on that. All right, let's get more into the data because this feels icky. Tim Fiore is chair of the Institute of Supply Management Manufacturing Business Survey Committee, and he joins us now. Okay, we are at an 8-month low. Or contracting the most in about 8 months for the ISM Manufacturing. You really had that weak employment data. What is leading this? Does this data surprise for you?
Yeah, Alex. So, this is a disappointment. So the last couple of months, we've been stuck, stable, stagnant. We're no longer stuck, stable, or stagnant. We're declining at a faster rate. We're off almost 2 points from last month. We're off almost more than 2 points from expectations. 21 months into a contraction, and we haven't seen a number at the headline level this low since November of 22. So first off, the good news, supplier deliveries are starting to stiffen up. It's a little bit harder for them to deliver. That price index number is a marginal expansion, very weak. Happy to see that, glad to see that. If you're looking for rate activity, that supports a rate reduction, no doubt. On the demand side, we still can't find demand. The demand is non-existent. Backlog is still extremely low. New export orders very weak, and no real end in sight. Our top 6 industry sectors all showed declines, significant declines, like 45 in the demand side, new orders, and production. But the big story here for the month is really the production number. We've been talking for the last year and a half that, look, as long as the production number stays around 50, revenues or expectations are being met. Profitability is probably okay. You just have to deal with the input side. Well, that's no longer the case here. We've fallen down to a 45.9. Big drop, disappointing, lowest since May of 2022. And then coupled with that, we've got the employment numbers sagging really strongly. So what it really says, and we've indicated this last month, the month before, is that without new orders, we're going to see a decline in production/revenue, and then we're going to see a decline in employment. And that's exactly what we've seen here. From a sentiment standpoint, I track headline sentiment month to month, running at a 1 to 1.4.
Right,
so I think we're in for a ride here. Now, the one last thing is we've been looking for a soft landing. That doesn't necessarily mean that manufacturing is going to see a soft landing. We could actually have a moderate landing or even a hard landing, and it doesn't mean that the economy is going to see a hard landing or a moderate landing. So we're at a real strange spot here. I mean, if you're looking for data, facts for the Fed to support a rate cut, don't look any farther.
Don't look any farther than this, right? All right, Tim, thanks for the breakdown. Really appreciate it. Tim Fiore, chair for the Institute for Supply Management on their business survey. Again, numbers coming in weaker than expected for the manufacturing front.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bloomberg Intelligence, Alix, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. So that means video too. So go to youtube.com and search Bloomberg Podcast, and that's where you'll find us. One of the stories that Alix and I like to continue to focus on is commercial real estate. It's undergone a tremendous change over the last 4, 5, 6 years, obviously with the pandemic, and longer term trends here that still need to be understood and worked out. So we like to talk to smart people to get a little bit smarter on this. Hilary Spann joins us. She's Executive Vice President at BXP. BXP is a publicly traded real estate investment trust. BXP is the ticker handily. Market cap $11.2 billion. Stocks pretty much unchanged today, up about 2% year to date. Hilary, thanks so much for joining us in our studio. New York City. Let's focus on New York City. That's your remit here. Yeah. a lot of empty space here in New York City in the offices. Mm-hmm. Tell us where we are and how we're going to get out of this, if at all. Explain to us how the commercial real estate environment is in New York City today.
Sure. Well, first of all, Alix and Paul, thank you for having me this morning. I think that it's fair to say that the market is bifurcating itself, and that means that there are groups of properties that are performing quite well, actually, and others that are performing less well. Those properties that are newly constructed, that have been reinvested in by their ownership, and that are well located are generally doing pretty well. And as evidence of that, if you look at the vacancy rate in the Park Avenue submarket of Manhattan, it's less than 10%, which is quite tight by historical standards. You're seeing landlords there with the ability to push rental rates, to reduce concessions like free rent, like capital that's associated with new leasing. And so therefore net effective rents are actually increasing in that submarket. In some of the weaker submarkets and some of the older buildings, landlords have had more trouble attracting tenants. But for those businesses that are generating revenue, that have clients that need to come visit them, that want to attract talent, being in a great building in Manhattan is a really good bet for them. And you're seeing strength in that segment of the market.
So we've had some property people in here who've talked about those older buildings, and over the last few years, they spent a lot of money retrofitting them and updating them to make them more appealing. Are we seeing a lot of that still? And like, what's the cost profile for that? Like, is it pay off? Like, how does that work?
So I think it's also a little bit location dependent. You're certainly seeing some buildings spend money that would be classified as older or maybe less well amenitized, just not a newer building. But if they're in a great location, they can actually do quite well. And I would point to the Grand Central submarket as evidence of that. A lot of people who commute in the city are really looking for a one-seat commute, meaning they get off of Metro North or they get off of Long Island Railroad, they walk to their office. And so those buildings, despite the fact that they're somewhat older in that submarket, are leasing quite well. And a lot of the landlords that own in that district are amenitizing their buildings to great effect. The cost of construction have gone up radically over the last, call it 5 years, and that does definitely have an effect. It tends to favor the landlords that are better capitalized. But for those that can do it, it really does benefit their leasing velocity.
How about, like, I'm going to reference this once again. I always do when having commercial real estate discussions in New York. Bloomberg News put out a piece maybe 18 months ago, and just focusing on 3rd Avenue between Grand Central and here. We're at 58, 59th Street. You can't give that stuff away. Or talk to us about that market. I'm thinking like the Lipstick building. When I see one of those buildings trade, is it going to be at a 30% discount, 40, 50, 60% discount? Talk to us about that kind of market. Because those are more, I guess, B properties, as I understand it.
Well, so there actually has been some activity on 3rd Avenue. Memorial Sloan Kettering, I believe, took some space in the Lipstick building.
Okay.
One of the office buildings that is on 3rd Avenue was recently announced to be a conversion to residential. So folks are getting creative with that space. For us, in our submarkets, we're focused on attracting large corporate tenants and investing the capital that's required to attract and retain them. But I think that 3rd Avenue has hope.
So let's just game this out for a second. So swaps market's pricing in 3 Fed rate cuts now for September, right? I mean, excuse me, for the rest of the year, starting in September. Let's say that happens. What's the trickle down to the commercial real estate market in the short term?
So the transaction volume, acquisitions, dispositions has been somewhat muted. Not so much as a result of where treasuries are trading, I think, but how quickly they went from practically zero to where they are today. Any relief on the 10-year, I think, would tend to support higher transaction volumes. In our space, which is, again, the sort of higher end of the market, there's been very, very little transactions because, in general, landlords are not distressed and are not willing to sell at depressed prices. So I think it would tend to support a higher transaction volume going forward.
You guys, BXP, well-capitalized, well-experienced owner of real estate. Are you buying in New York City today?
At the moment, we don't have active acquisitions, but we're constantly looking for new opportunities. The real gating issue for us is quality. So if we cannot find something that is at least equal to the quality of what we already own, we are not buyers. And the fact of the matter is there's relatively little available in the market for purchase that is consistent with our quality. That having been said, we do have a couple of development sites in New York City. The most active of which will be 343 Madison this year. It is
Where's that?
is between 44th and 45th on Madison, and we will begin constructing the east side access to the Long Island Railroad in Grand Central between now and the end of the year. So folks will actually see cranes and construction on the site.
So I live in Brooklyn. What about in Brooklyn?
All the cool kids.
All the cool kids. No, but they're like retrofitted, like that sugar factory. Not you guys, but sugar factory is retrofitted. Like they're
Domino.
There we go, Domino's. Is Brooklyn becoming a place where commercial real estate can truly thrive?
So I would say that the demand for Brooklyn right now is a local demand. People that need to be in Brooklyn for a reason. Their manufacturers are located there, their talent base is located there. Those tend to be the companies that are expanding in Brooklyn. We own a building called Dock 72 in the Brooklyn Navy Yard, and we've had success in that building with leasing to Huge, which is a marketing company that was formerly based in Dumbo, has moved to the Navy Yard. The Pratt Institute and other large sort of Brooklyn-based institutions. I would say that Dock 72 has attracted the majority of the large tenants that are active in the Brooklyn market now, but no question, it's sort of a local demand market at the moment.
You guys own the General Motors building, one of the most iconic buildings in the city. Tell us about that building.
So the building is 96.5% leased. Wow. We recently had a client expand by 100,000 square feet in the building, taking up most of the availability in the building. We recently spent a lot of time and effort amenitizing the second floor of the building with wellness, with food and beverage options, and with conferencing, which I think is increasingly important to clients today. And it's really borne itself out in the leasing that we've been able to achieve there. So the building is basically full.
So when we say wellness, what does that mean?
We have a 17,000 square foot gym that has personal training. It has physical therapy. It has massage available. It has locker rooms that are like a spa.
Yeah,
it's great.
I'm in. You said massage. I didn't hear the rest.
Anytime you want to stop by, let me know.
There we go. What would you guys what doesn't make sense right now? Like if people, clearly sellers are going to want to be out there selling their property. It's obviously the price is going to be a problem. What have you been pitched to that you're like, no way, why would anyone think that's a good idea? Or is it just a price situation?
No, for us, again, I think it gets back to quality. There are certain assets that we would not want to own just because we don't think that they can be made into a premier workplace, which is where we're focused. That's our segment of the market. And so our gating issue is it already premier or can it be made to be premier through reinvestment? And those are the assets that we're interested in, nothing else.
Are your clients, where are they in terms of back to work? Are we now at the new normal, whether it's 3 days a week or Bloomberg's 4 days a week, for example? Are we at a new normal? Is that what your clients are telling you?
So in our space, again, our buildings tend to have people who are revenue generators for their companies occupying the space. They have been back to work, and it's really not so much a topic of conversation in our office at all anymore. We are at or above physical occupancy that existed pre-pandemic today. Now, it's off a little bit on Fridays and Mondays, but in the middle of the week, we actually are right back where we were before the pandemic.
You guys also own the 599 Lexington, that beautiful building. Yeah, it has like a tower. It's like
that's 601, I think.
Oh, 601. That's 601.
Yeah.
And
599 is right across the street.
Yeah. How are those doing?
They're great. So 601 Lex has 9,000 square feet available. It's a 2 million square foot building, plus or minus. And 599 Lex is where our offices are, actually, and that building is very well leased as well. We do have a little bit of space coming available in that building, and there is a lot of demand for it. People are calling us and saying, we want it, and can we have it now?
But, right here, Lexington, 58th and 59th, all these stores are empty, except the chocolate store, because everybody needs chocolate.
Yeah.
What's going on in your buildings? Do you have that ground floor retail? Is that a component of your buildings?
We do. We have lots of retail in our buildings. We built out a food hall in 601 Lex. We also have street level retail. Look, we think of our retail as complementary to the office experience. And for our clients that have office space with us, we want to make sure that they have a great experience going out and grabbing something healthy and fresh and convenient for lunch. And so we've really looked at our retail as a way to complement our premier workplace and not just as a revenue generator in and of itself. And we've been able to attract really, really great options. So I think, our approach has been very successful, but it's very much done with our clients in mind.
Really great stuff. Really interesting. Thank you so much for coming in. Come back. Keep us updated. We love touching on this topic. It's also important.
Can I point out an
yes.
architectural oddity along Park Avenue for
You sound like my
office
husband,
buildings?
but yes.
No, it's true because the lobbies are all raised, kind of, if you go down there. And that's because I suppose the lack of elevator wells, because underneath the buildings, you can't go down. There are railroad tracks.
You are exactly
Look
right.
at John Tucker bringing out some
How
New York
did you
City
know that?
knowledge.
No, I'm just.
Did you research that while we were there? Was this what you did for the last
What,
10
just
minutes?
now?
Yeah.
No.
He saw a YouTube video on it. That's where he
mean,
gets all his knowledge.
That's
But think about it.
He
Walk
was
down
trying
Park
to construct
Avenue,
his
all the
own
lobbies
table
are
saw.
up.
Yep.
But you're exactly correct. That's
There.
why.
Okay.
Thank you very much.
Thank you, John Tucker.
I did not
The
know. I've lived in
brilliant
the city all my life.
More
Hilary
useless
Spann,
knowledge.
thank you very much for joining us. Hilary Spann, Executive Vice President in BXP, joining us live here in our Interactive Broker Studio. Talking about commercial real estate. Again, I guess the story I'm learning is if you've got good properties, you're in good shape. If you have something less than good, then perhaps still a struggle out there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Busy earnings cycle here for the tech names. We had Meta last night. Some good numbers. That stock trading up. And big afternoon today after the close. Apple and Amazon report. Let's check in with one of our go-to tech folks, Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. He's not in our studio, and he's not even Zoom, so we can't even see what
his
outlandish outfits.
He's probably wearing like a black suit at this point, and we can't see it. It's upsetting.
Exactly. Dan, thanks so much for joining us here. Let's start with Apple here. I kind of feel like they need some more explaining to do in terms of, some of their strategies here in terms of the market in China. What are you going to be looking for from Apple?
I mean, it's really about the China growth. We think it's the last negative quarter for China, and then that starts to now have a tailwind going into the AI-driven super cycle. And I think this is the beginning of what's going to be a historic period for Apple, and I think broader tech. As this week's validated, the AI revolution is real, and now the consumer piece comes through Apple.
So this is still going to be a show me story, though, Dan, because all the indications we've gotten from China, from any sector, is not good.
Well, our checks in terms of units, which originally for iPhone 16 was, let's call it 84 million, which is now up to 90. So the point is, like, for iPhone 16, that continues to ratchet up. But it speaks to our point. The haters hate Apple at 160, despise it at 200, and will absolutely hate it at 250. So as we're going into this phase, it will be proving, but betting against Apple and Cupertino has been the wrong move.
So talk to us about the services side of the business, Dan, because for a long time, a lot of bulls were saying you got to focus on services because that's the high margin business and it takes you away from the replacement cycle risk and all that. Is services still a key story for the Apple stock?
Oh, I mean, Paul, you've talked about this a lot. I mean, services is key to the valuation of Apple. It's been big to the sum of the parts story. And actually, I'd say the biggest way that maybe people have missed Apple is not recognizing that this essentially was a re-rating story led by services the last 2 years.
Mm-hmm. So when it comes to their indications on their own Apple intelligence, Mandeep Singh from Bloomberg Intelligence was pointing out that, Apple doesn't have its large language model. So what do you think what are the questions that you and other analysts are going to have on the call about LLM?
The big focus is really developers. Developers now will start the process of building hundreds of apps on the Apple ecosystem. So I think Cook talking about what initial feedback is from developers, maybe giving some breadcrumbs into iPhone 16, that's going to be the important thing. But if you take a step back, 270 million have not upgraded their phone, Paul could be included, in the last 4 years.
Boom.
And I think now you go into what should be is an AI-driven super cycle.
So from your perspective, Dan, has Tim Cook and Apple, have they allayed the concerns of investors or some investors that Apple's really not going to be a prime beneficiary of AI. Have they allayed those concerns, do you think?
Oh, I think they have. I mean, look, goes back to WWDC. Stock was 190, right?
Yep.
Everyone thought it's over. They didn't show it. Look at it today. And the point is, because I think now the street recognizes that the AI revolution on the consumer side goes to Apple Park. On the enterprise side, it's godfather of AI, Jensen, NVIDIA, as well as Nadella. But on consumer, it's Apple.
Yeah, it's such a good point. And I think you made that point with us on our show a few weeks ago, and that was a good distinction, right? Which kind of brings us then to Amazon, because Amazon has the consumery side when it comes to just e-commerce, and then it obviously has the cloud, then that AI side. What are you expecting after the bell? That stock is flat now on a pretty heavy tape.
Big focus is AWS. Look at the cloud strength we saw from Alphabet, despite the knee-jerk rise continue to be a head-scratcher. Look at the Microsoft cloud number. I think Amazon's going to be cloud strong on AWS, and that's important for them to show, don't forget about us when it comes to the AI revolution. That's what Jassy's really going to be focused on in the call.
So give us a sense, Dan, about how investors should position Amazon Web Services in the context of the AI play. How do they fit in really?
Yeah, it's a great question. I view it as if Apple could show, and I believe they can, that they can monetize that leadership position in cloud and actually monetize from an AI perspective, very similar to what Microsoft's doing to Google. That then all of a sudden from some of the parts could add significant value to some of the parts of the Amazon story. So that's really what they need to focus on. Consumer is what it is. I mean, advertising and margins, you could kind of, some focus there, but it's really about cloud and proving that they will be an AI beneficiary.
How did we see that in the line items when it comes across?
It's really around AWS strength. We expect upside. And then on the call, walking through not just Anthropic, but like the overall AI strategy and what they're starting to see in their customer base. You triangulate that with Alphabet, Microsoft, AMD, it's 9 p.m. in the AI party. It goes to 4 a.m.
There we go. There's the headline for you. What about CapEx for Amazon?
I want to see them continue to accelerate it. To me, it's an arms race that's going on. So as much as you could fret about some of maybe the CapEx, that's what you want to see from Meta. You want to see Microsoft. You want to see from Amazon. Now, investors will be like, okay, where's the payback? Rome wasn't built in a day. This is going to take 6, 9, 12, 18 months. But at the end of it, fourth industrial revolution. Amazon wants to be a huge part of that. And that's what investors want to see. Even though bad is good, good is bad.
Microsoft, just, one segment on that, Dan. How's the Microsoft story shaping up for you? I know you've always been very supportive of the stock. Where are they right now?
It was a validation moment. I mean, the reason tech went green yesterday and all the white knuckle fields were away, it was because of Nadella talking about the acceleration in Azure and talking about AI monetization is now here. Because there's two people that everyone in the world's focused on what they say on AI. Godfather of AI, Jensen, Nadella. And what you heard from Nadella, that the Rubik's Cube that you're trying to figure out, that was bullish in terms of AI validation, combined with what Lisa Su talked about from AMD, very bullish.
So before I let you go, Dan, we're looking at a day where stocks are selling off. We definitely had bad news when it came to the ISM Manufacturing data at the top of the 10 o'clock hour. How much legs do you think this maybe next move of the tech sell-off can have?
I think this rotation from big tech to small cap we think is very short-lived. Fed's next move is to cut in that cycle with big tech earnings that we're seeing. I'm not saying that you're not going to have some speed bumps here, but we believe we are still in the early stages of this tech bull market, and that's how we've handheld investors through some of the roller coaster.
All right, Dan, thanks so much for joining us. Dan Ives, he's a managing director, senior equity analyst at Wedbush Securities, giving us his thoughts on big tech. Again, after the close today, Amazon and Apple. I'll be paying attention
I'm
from
excited.
the beach.
Yeah, I
I'll
think it's
be
going to be
paying
really fun.
attention.
I was really surprised about Meta. I mean, I was really skeptical going in terms of they don't have the same kind of cloud plus AI to deliver, but that ad impressions and in terms of the quality of the ads was really quite impressive. So I was surprised, and that stock holding up despite the sell-off in the equity market.
Yeah. So, I mean, I think for Meta and for Google as well, anybody who's selling advertising, what AI does is allows you to better target your audience, which is important for advertisers because they don't want to waste their advertising dollars. They want to make sure every advertising dollar is going to someone who they really want to reach. And that's one of the advantages of digital advertising overall versus, say, buying a TV ad or buying an ad in the newspaper or something like that. You're getting everybody, people you don't want as well. Digital does a better targeting. AI just makes it even better.
Yeah. And it has a premium? Does digital have a premium
Yes.
to TV?
Oh, yeah.
Oh, okay.
Yeah.
All right. But
So
it always has, hasn't it? In the last 10 years or so?
Yeah, I mean, it's interesting. They target different advertisers, but the CPI the cost per point is really interesting. So it's just a premium. They're taking share across the board.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's continue our conversation on commercial real estate. We heard from someone earlier today, a guest who really is focusing on the New York market. In New York, if you got A-listed properties, you're fine. If you got B and C, not so fine here. But let's broaden it out a little bit. We can do that with Greg Friedman, Managing Principal and CEO of Peachtree Group. I'm just guessing it's Atlanta. He joins us live here in our Bloomberg Interactive Brokers studio. Abigail Doolittle joins us as well. We appreciate that. Abigail Doolittle, markets reporter for Bloomberg News. Greg, thanks so much for joining us here. Talk to us about Peachtree. How do you guys play the commercial real estate business? Equity, debt,
Sure.
regional, where do you guys go?
Yeah, so we invest across the U.S., so it's just domestic, but we invest up and down the capital stack. So we invest on the credit side as well as the equity side of commercial real estate. So we're a little bit unique in the sense that we do, as part of our, company, we have different verticals that go out and actually lend to commercial real estate. We buy a lot of debt from financial institutions and banks and regional banks. We also buy and develop real estate. We buy and develop primarily hotel assets that are, select service, limited service type hotel properties on the equity side, but the credit side we're diversified.
All right, I'm trying to get a sense, and I think a lot of people are trying to get a sense, is how bad is a commercial real estate out there, and where are we going to see it? Where are we going to feel it? Where are we in the kind of this 9 innings of trying to normalize this market when people's behavior has really changed, whether it's working or traveling and that kind of stuff? How do you guys think about that?
Yeah, I think commercial real estate's very bifurcated today. If you have like a long-term fixed rate loan, you bought an asset several years ago, you feel really good about where you sit in life, assuming that loan's not maturing here, in the near term. If you have loan maturity issues, if you're, if you're dealing with, loans that are floating rate that are unhedged, you're dealing with a lot of that balance sheet stress. You hear a lot of the headlines talk about the stress that's going on in office, which is really just that secular distress. You take office out of the equation, real estate with loans that are maturing are under heavy pressure right now because these rates are resetting, in most cases, double or even triple what they were paying, from the previous loan.
Well, let's talk more about that because by the end of 2025, let's call it more than 1 trillion to 1.5 trillion CMBS coming due. Because you are on the credit side, you're really seeing the plumbing a little bit more closely. It's interesting. There's this debate among some of the commercial real estate people that we speak to, and some are a little bit more optimistic, saying it's just office, and then there's others. And Josh Zegan is coming to mind, strictly on the credit side, very close to the banks, saying it's much, much more negative than people think. Where do you stand on that? Do you think it's a much more difficult position than, say, some of the Blackstone activity might suggest?
Personally, I think it is. I think it's a lot more negative. There's a lot of negative leverage. So if you're buying assets today, in a lot of cases, you're having negative leverage because rates are so much higher than where a lot of these assets are trading on a cap rate basis, even though cap rates have moved up. And not to mention, if you bought an asset pre-2022, especially during the pandemic, cap rates had compressed down to this like unsustainable level where a lot of assets, if it was like a multifamily asset, industrial, were trading in this 3 to 4% range, in some cases a little bit higher, but rental growth rates haven't really allowed for those cap rates to grow enough to sustain interest rates that are, again, in most cases, you're in the, mid-single digits at a minimum, if not higher single digits. And that's what's causing, a big challenge across commercial real estate.
All right, so I'm sitting on a piece of real estate down in Peachtree Street, Southwest in Atlanta, the worst city in the country for naming streets, by the way.
Right.
I mean, it's like by a bunch of second graders. I'm sitting on a piece of property. My mortgage is coming up. I got to refinance it at twice or maybe three. What do I do?
Yeah,
What
so
happens
there's definitely debt out there today. The reality is regional banks, community banks, the national banks make up 50% of the commercial real estate lending market. They're not lending at the same level that they once were. Groups like us on the credit side, we're doing lending today. We've done about $1 billion of loans this year so far. So we're actually providing loans to groups that need to recapitalize or refinance as loans are maturing. In a lot of cases, though, using that example, they're going to have to come in with additional liquidity. So they're going to have to do potentially a cash in. Exactly. They're going to have to come in with capital to allow for that refinance to occur, that equity.
So speaking to the other side of your credit business, you also buy, and during the pandemic, you were one of the biggest buyers of loans. I would imagine there's a lot of bargains out there today. Are you super active?
Yeah, so we bought over 180 loans during the pandemic, so we were super active, as you mentioned. Today we bought, this year we bought close to about a dozen loans since the end of last year to, today. So we haven't bought as much paper as I would expect.
Where are you buying that on the dollar? Although I know some folks say that's not a good way to look at it, but like in terms of what kind of bargain are you getting?
Yeah, so what we found
in what assets?
Yeah, so it's not huge discounts, because what we're finding is, unlike during the great financial crisis, because we bought a bunch of loans then, we got huge discounts. And back then banks had done higher leverage lending, going into this cycle and even into the pandemic, leverage levels were much more, I would say, conservative by most, banks and financial institutions. So the discounts weren't as large, but we're finding that the banks that are trading paper, they're usually selling off their better paper, which means that it's loans where the asset value is greater than the loan balance. And so the discounts just aren't as large given that factor. So
how hard is it to come to agree on pricing?
It's very challenging because
is it easier or harder now than 8 months ago or something?
It's still
really
hard. Yeah, it's still very hard. I think that's going to change towards the end of this year because part of the challenge, the losses that different banks need to take, they don't have the reserves to take them, and they're not willing to take those losses today. I think that's going to change as their loan loss reserves are increasing over the next couple of quarters. And I wouldn't be surprised if you saw a lot of regional banks sell off a lot of paper in the fourth quarter this year.
Do you think the commercial real estate business, I don't know, pick however you want to answer this, has it found its bottom yet, or are we still searching for a bottom in valuation?
Yeah, so I think a lot of people believe we found a bottom. I question it just because we don't have a very active transaction market. It's very muted on the transaction side. I do think we're probably closer to the bottom, although I wouldn't be surprised, depending on where rates settle over the next 6 to 12 months, that will be a big indicator. When I say rates, really the 10-year Treasury rate. I mean, the 10-year Treasury rates come down, below 4% today, but that's still double where we were pre-2022 when you look, over that decade where we averaged closer to 2%. So that's putting a lot of pressure on the underlying values of these assets, and that, potentially means values could potentially reset higher if the 10-year truly stays above 4%.
So in terms of that bottom, no matter who you talk to, whether they think that things have already bottomed out or if they're going to bottom out in 6 months or 12 months, one thing that everybody involved in commercial real estate seems to agree that this is going to take a long time to work out. Do you agree? And if you do, how long is it? Are we looking at a couple of years just scuttling along the bottom of, and why is everything so log jammed? When does it break up?
Yeah, so I'm a big believer that we're going to have it's been sluggish over the last couple of years. So starting, going back to the end of the first quarter of 2022 till now for commercial real estate, it's been a very sluggish period. And I think we're going to continue to have that, unfortunately, that sluggish period for commercial real estate over the next several years. And it's just going to take time as these loans are maturing, asset values continue to sort of, really ownership groups have to recalibrate to where the new interest cost is. Mm-hmm. So it's just going to take time to get through this slug.
Well, that's what I'm really interested in, because let's just say we get 75 basis points of cuts this year,
sure,
right? As swaps market are now pricing in. How immediately does that affect what you see?
Yeah, I personally, I think it doesn't really move the needle that much. I mean, I think it helps a little bit, but it doesn't really, it's not as impactful as you'd think. I mean, it obviously brings down debt service costs, floating rate debt, by, call it 15%, which is helpful, if it went down 75 bips, roughly about 15%. But your interest costs, if you think about it pre-2022, you're still up, call it 17x, because, you were next to zero, right? Like what people are paying off of SOFR, and now all of a sudden, you move down 75 bips, it's not going to be, probably as helpful,
So going a little bit more macro, I know that about 30% of your portfolio on the equity side, hotels, mid-level hotels, you own, I think, 90 of them or so, although some of that might be credit. Sean Hare of Trinity Investments joined us last week and also joined Alix and Paul, and he was saying for luxury hotels right now the growth is 8%, but for lower level hotels it's down 2%. Are you seeing this, and what does it say about the consumer? Because we continue to see this bifurcation on the consumer between the high end and the low end. Are you seeing that relative to your hotels?
Yeah, I think without question, I think consumers that are on the lower end side obviously are impacted by inflation, higher debt expense. The luxury segment hasn't been as impacted, and that's because consumers held up much better, this time around. I do believe, when you look at our portfolio, we're in the mid segment, and so we have a lot of select service hotels that are like Marriott, Hilton branded assets, and those hotels are continuing to have positive RevPAR growth. So we're up about 3%, year to date, but you're definitely seeing, occupancy slow down. RevPAR is...
I know. Okay. Revenue per available room.
That's right.
I was going to show off to Alix and Abigail. Just real quickly, if you were to go buy a piece of commercial real estate, an office park in suburban Atlanta, what kind of discount do you think you'd get off of the pre-pandemic valuation?
It really depends on the asset.
Because it's only 70% out. I've seen this property 1,000 times in 1,000 towns. It's 70% occupied. It's parking lots half empty, all that kind of stuff.
If it's going to trade, you're getting like 50% discounts.
Wow.
Is my just high level number without going through the nuances, and potentially you're even seeing larger discounts for some of these assets to trade. There's one big asset in Buckhead, Atlanta right now that's coming to market. Or at least the debt's coming out to market, and it's going to trade at a pretty substantial discount to where it was, pre-pandemic.
And Buckhead's still Buckhead.
Buckhead's still Buckhead, yeah. It just shows you the challenges.
The Ritz-Carlton
in
in
the
Buckhead, they loved me back in the day.
They loved you back then?
Yeah.
Now, not so much. This was a really fun conversation. Thank you both so much. Greg Friedman, Peachtree Group Managing Principal and CEO. Abigail Doolittle, Bloomberg News Markets reporter, who also has her real estate beat as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.